This week's feature stock is Lowe's hardware store, and the reason I emphasize hardware store is that when I first came out here to the site to prepare for this video, I typed in L. I got Lowe's Corporation. Seemed reasonable that that's who the company would be, and started looking at it. And when I got down to the bottom, I realized it was saying it was in the insurance industry. Well, that's the wrong Lowe's. So good practice is to go look at the industry and make sure that you've got the company that you think you've got, or you're analyzing the company you want to analyze. You may want to also take this link, go out here, and you can look at profile and just ensure that the company that it is who you think it is. All right, so back to exercise of analyzing Lowe's, the hardware store. Lowe's is unique in that it's got a competitor, Home Depot, a direct competitor of Home Depot. Not, as you know, most companies don't have such a direct competitor. McDonald's and Burger King maybe, you can go through the list, but it's a pretty finite list of direct competitors like this. So it is interesting, and we'll be comparing it to Home Depot. First thing I notice about Lowe's is the price momentum. Just to refresh you, this is the Polaris website is not a technical charting application. It's based on sound fundamental valuation, discounted cash flow. But it is interesting to look at recent enthusiasm that the markets had for the stock, which price momentum seems to reflect. And you can see here that Lowe's has had quite the run-up in the last 3 months. Compare that to Home Depot, which hasn't had nearly the run-up over the last 3 months. While we're over here looking at Home Depot, it's also interesting to note that the growth for Home Depot is being defaulted to 10%. Still results in a pretty low expected investment return, but a high growth. So it looks like the market's gotten pretty ahead of itself, at least on the surface, looking at Home Depot. Over here, when we look at sales growth for Lowe's, notice that the sales growth is much smaller. It's more than half compared to Home Depot. So definitely want to look into that. All right, some other input values that we typically look at is down here, namely the PE ratio. PE, when I compare that to Home Depot, I see 12.5 for Home Depot and about 12 for Lowe's. So if that comparison makes it seem pretty reasonable. We also got profit margin. Looks like the profit margin is expected to improve a little bit, and then quite a bit of repurchasing of stock shares. And we compare that to Home Depot, same kind of thing. High purchasing of stock shares, and the profit margin is around 8% compared to 6.4. So I would think it'd be reasonable to assume that the profit margin would improve once it hits stable, and maybe that's why the current price is a little bit down, as the profit margin is, that's a 50% improvement in profit margin if we go from 4.6 to 6.4. So that probably has a lot to do with the current market price being a little bit down. But yeah, 6.4% seems reasonable. PE of 12. Remember, 15 is the average across the S&P 500 historically. So when you go below 15, it means there's one of two things: either the certainty of cash flows is more uncertain than the overall market, so it'll give market will give a lower price for those future cash flows or earnings. Or the other could be that you have negative earnings being forecasted. I don't think once Lowe's hits stable state that we should consider in 5 years that they would continue on in some negative growth state. In fact, we got to consider the opposite of whether they would continue on with the growth of the economy. Of, let's say, a typical forecast would be 2.5% of the growth of the economy. If we think Lowe's could continue to grow at 2.5%. Now, that growth doesn't come without reinvestment. So the formula we talked about before around PE is just 1 divided by the cost of capital minus the growth. But really, if you've got to also include uh, reinvestment, which would lower that number just a little bit. But there's a video out there that on the PE ratio that you can watch that would go through more of that. I'm just trying to think through whether I would want to modify the 12 to in any way, and let's think about where we are with cost of capital currently, 8.5%. Let's compare that to Home Depot. Their cost of capital is 8, so that seems reasonable. Now, if we went with 5 years from now, with still cost of capital of 8%, 1 divided by 0.085, yeah, it puts you right around 11.5, 12 PE. Actually, more closer to 11.5. So yeah, if you assume some kind of what's the yeah, a little bit of growth occurring with brand recognition that would occur even 5 years and beyond. Yeah, I can see it go up to 12, maybe 13, but not enough that I would, for this quick analysis, I would change the PE. I wouldn't change the profit margin. I wouldn't change the issue trend. I never would change the cost of capital, as I've talked about in previous videos. That's just simply takes this future price, reminder of the formula, what we're looking at for the discounted cash flow evaluation. But all you're doing with cost of capital is you're taking that final price, which is your sales times the growth times the profit margin, which is earnings. Earnings divided by shares is earnings per share, PE, then you get a future price. It's really all we're mostly interested in is future price. You could discount it back, but it's for valuation, or really getting to this investment return. It doesn't really it's not worth changing. So the main or one remaining value would be over here. This refers to 5 years. So the default period that we assume this growth of 4% would be for 5 years. And then after 5 years, we assume mean reversion, and that the lows would continue to return exactly what the market expects in terms of growth. But here in the next 5 years, we're assuming 4%. So we might want to change the length of years that we would assume that this growth would occur. Well, I don't see anything going on uniquely with Lowe's that says this next 5-year period is, there's anything that unusual going on with the company that would make me want to extend the period. It seems like this is kind of a company that you can count on. Kind of, people always are looking for home furnishings. It's kind of a consumer staples kind of company that will continue to thrive in good times and bad times. So I don't see this 5 years being much different than subsequent 5 years. So it's just no point in extending the period. So really we're down to just the main input parameter, which is into the valuation formula, which is typical, which is growth. And that's why growth is the one value that's presented directly for the user on the Polaris website to modify. Well, when I compare it to Home Depot, again, Home Depot is at 10. So I have to go out and figure out why. Let's go out here to the CNN site and see what their analysts, their consensus analysts are saying around growth for Home Depot or Lowe's. And yep, they've got the same number, 4.77%. So that doesn't really shed any light on why, or any difference of opinion of why it wouldn't be more like Home Depot. Well, let's go ahead and bump it up to 10% like Home Depot and to see what the upper range might be if we were to go up to 10%. We get up in an investment return of maybe 7.5%. But that's still not enough of an investment return to really make this worth investing in. And if we take it, even if I go to the default, it's 3.9. If I go to the or if I go to the industry, it's 3.9. If I go to the default, it's 3.1. It's just not enough upside here to really make worthwhile to invest in Lowe's right now. And I think the biggest thing that's made Lowe's not currently an attractive stock to purchase is the run up. We've had above what the market's run up, and over the last 3 months the market's run up in the neighborhood of 7%. So we've just seen an enormous run up in the price, and we're just late to the game here. If I go out and look at lows on the well, I guess I've lost. I thought I had it on Yahoo, but if we go out and look at Yahoo real quick and just see what that price has done. Make sure we enter the right ticker. Now let's just look at the, let's do it over like the last 6 months, and yeah, you can just see here that this run up we've had from 85 to 107, and then here just recently a very big move from 97 to 107. So late to the game, and not recommending for this currently. Not recommending this stock currently.